Hey there, awesome accounting student. Mark Franke here. This is Accounting 101, Chapter 9, and this is on warranty liabilities. This is problem 9-4B that is going to illustrate this, and this is a company that makes grinders. So here's the issue with warranty. If we make a product, or even if we buy a product, but if we're going to warranty the product to our customer, we want to make sure that we provide a liability for the cost associated with providing that liability. So if we make refrigerators and we say you have a year to bring the refrigerator back and we will fix it, actually with a refrigerator, we'll send somebody out and they'll fix it or replace it for a year or 5 years in the event of a car or something like that. So we don't want to violate the matching principle if we have an expense in a future year that relates to a sale that we made in the current year. So that's why we are accruing for these warranty liabilities. It's to match the expense of the warranty to the period where we made the sale. So, in other words, if we sold a refrigerator in December, but we sent somebody out to fix it the following May, and we had the sale in 2019, and we had the expense of repairing it in 2020, that would be a direct violation of the matching principle. So that's why we're setting up these liabilities. So let's see how this works. This is the Lee Company, and again, this is problem 9-4B. Let's go ahead and do add a row so that I can put problem 9-4B, just so that we have it there. Okay, so the first transaction on the 16th of November was we sold 50 of these grinders. We sell them for $50 each, and we pay $24 each for them. So we are going to debit cash. These are customers, are cash customers. Debit cash, $2,500. Credit sales, $2,500. That's to record the selling price. That's 50 grinders at $50 each. And then we also want to record the cost. Cost of goods sold is a debit, $1,200. And credit merchandise inventory. So we're taking it out of inventory and we're throwing it into an expense account, cost of goods sold. Then at the end of the month, we want to make a warranty accrual for all of those sales. So we're going to take the $2,500. That's what they told us is we would be accruing based on a 10% of the sales value. That's pretty doggone high, but that's the facts they gave us. So 10% at the selling price. So this is a debit to warranty expense and a credit to warranty payable or warranties payable for $250, which is 10% of the sales. Then we continue on. Now, we haven't had any grinders come back to need repair yet. So then in December 12th, 6 grinders did come back in the door. And so we had to replace them. These things are going in the trash. So we're going to now pull 6 grinders out of inventory at $24 each. It's $144. Debit the warranty payable. We're relieving the payable now. And credit merchandise inventory because they came out of inventory. So they're going, its inventory is going down. Then we had our cash sales on the 18th of December, where we sold 200 grinders, again at $50 each. That's $10,000. Excuse me. And these are also $24 each, so we've got 200 of those. That's $4,800. Debit cash, credit sales, $10,000. Debit cost of goods sold, $4,800 credit merchandise inventory, $4,800 to take them out of stock. Then we had 17 more grinders. This is on the 28th. 17 more grinders came in defective. We threw them in the trash. We took 17 off the shelf and we shipped them out. Or maybe we just gave them to the customers. So, but we're relieving the warranty payable again. Debit warranty payable 408. Credit merchandise inventory 408. And that is, again, for the 17 defective grinders. We're taking it out of inventory and we're applying it to the warranty payable. Notice there's no expense involved here because we already provided the expense when we accrued for them back in November. Then we need to accrue for the sales that were made in December. That was $10,000 in sales. At 10% is debit to warranty expense for $1,000 and credit warranty payable. We're beefing up the warranty for the units that we sold in December. Then in January, we sold some more. We sold 40 grinders, $50 each, $24 was our cost. Debit cash, $2,000, credit sales, $2,000. Debit cost goods sold, $960, credit merchandise inventory, $960. This is to record the sale. And then we had some more come back. And those, that was 36 grinders came back. Some of them had probably been sold in November, some might have been sold in December, and some might have even been the ones in January. So we debit warranty payable $864. This is 36 grinders at $24 each. Credit merchandise inventory, we're taking it out of inventory and we're applying it to the liability account. And then at the end of January, we're accruing for the sales for January, which is a debit of $200. This is 10% of $2,000. Our sales were low in January, and credit warranty payable for $200. And that's the end of those transactions. But they've asked us to prepare some schedules. And this is requirements 2 through 5. Okay, so I've prepared some schedules here. The first thing they've asked us for in requirements 2, in requirement 2, is what was the total warranty expense for 2019? So if we go back to the journal entries and just look at the 2 accruals that we made, one for November, this was November 30th, and one for December on December 31st, we recorded expense of $250 and $1,000 for a total of $1,250. So that was the expense, and so the debit in those journal entries went to an expense account. And then for requirement 3, they're asking us what was the warranty expense for the new year in January, and it was only $200 because we only sold $2,000 worth of the grinders. So then I've prepared a T account of the warranties payable account. The warranties payable account is a liability account. Of course, that's what this chapter is all about, liabilities. Anything with the word payable is going to be a liability. So we started with no balance in warranties payable. This is a brand new thing. And then we recorded expense of $250 and $1,000, which would be a credit to warranties payable. During December, we replaced, 6 and 17, 34? 24 units, and that was $552. We had 2 journal entries for the replacements, and so that means that at the end of December, our balance in the warranty payable account was $698. That's for the December. I think there's still some November ones that could come back. 60 days was the warranty period. But anyway, we had $698 as a credit balance in the warranties payable account. Then in the month of January, we had $200 worth of expense because sales were $2,000. We replaced $864. That was in the journal entry, let's see, there it is, January the 21st. That was 36. And so we have an ending balance in January of $34. Based on what I'm looking at here, it's probably not enough. We probably didn't accrue enough because these things are coming back at a pretty high rate. And so we may have to change vendors or do something else because that this isn't going to work. I mean, we're replacing a lot of these grinders that need to go in the trash. Okay, so that's it for this particular video. Thanks for listening, and I will see you again next time.